The most dangerous myth in technical analysis, and the reason 90% of retail traders lose their shirts, is the belief that Elliott wave is just a counting game. You've seen the stick diagrams. You've seen the 1, 2, 3, 4, 5 scribbled on Twitter by every self-proclaimed guru. But here is the cold, hard data. Counting swings is not the same as identifying waves. Starting with price swings is a recipe for disaster because you learn to ignore the internal construction and the geometric rules that actually govern human mass psychology.
I've heard this before. Why is Constance Brown different? Most of these old-school technical analysis books feel like smoke and mirrors in a 2026 market dominated by high-frequency algos.
Because Constance doesn't start with labels. She starts with geometry. I've analyzed her asset allocation models against current 2026 volatility, and the box method she pioneered is one of the few frameworks that still holds up when you're vetting assets on modern trading platforms. Today, we are deconstructing the Wall Street-level strategy of mastering the Elliott wave principle to see how it applies to everything from gold IRAs to your equity portfolio. Geometry is not decoration. It is the first filter between market truth and market noise. We are breaking this masterclass into 5 strategic chapters. First, the geometry of price, understanding balance and proportion so you stop being fooled by fake-out swings. Second, impulse wave architecture, how to identify the strongest part of a trend before it's obvious to the crowd. Third, the asset trap, why most beginners misidentify corrections and get liquidated. Fourth, the BS detector, critiquing what is outdated for 2026. Finally, the mastermind consensus on capital preservation. And pay close attention to Chapter 4. We found a massive alpha gap in how Constance handles diagonal triangles that could be the difference between a 10% hedge and a total portfolio wipeout during a shift in mortgage rates or global cash flows. Let's go from theory into the chart itself. To master the market, you have to realize that the ocean traveler has a more vivid impression that the ocean is made of waves than that it is made of water. Most traders are looking at the water, the raw price data, but they miss the waves, the geometric relationships between those points. Constance teaches us that geometry is the heart and soul of harmonious relationships in the markets. If you cannot see and feel the difference between a market moving with conviction and one that is just chopping around, you'll never see a corrective pattern unfold in real time. Let's get technical. The framework is built on vectors and slopes. Constance introduces a box method to act as a physical ruler for your eye. You are not just looking at the price, high and low. You are looking at the height of the move and its duration. If you have an uptrend, you must always be aware of the longest bar in that horizon. If a single declining bar exceeds the length of the strongest bar in the previous uptrend, the longer trend is in serious trouble. Think of it like the architecture of a European cathedral or a mosque. There is a mathematical substance at the core, ratios that connect one unit to another. When a chart gets Elliott, it becomes a work of art because it reflects these proportional relationships. If you ignore this and just mechanically label waves, you are building a house of cards that will fall apart the moment the market proves you are missing a piece of the puzzle.
So how do I use this if I'm just starting with a small capital portfolio?
You use the boxes to test for trend damage. If a retracement overlaps a prior retracement of equal size or duration, or overlaps the previous range by more than 62%, the trend is likely dead. By comparing the slope and angle of swings, you can see when a move is accelerating into a bottom versus just drifting. If the slope of the counter move is steeper than the preceding trend, do not buy the dip. Now we move into the actual engine of the market, impulse waves. These are the strong trending price moves that build wealth. Every major trend is built on a 5-wave structure. Waves 1, 3, and 5 are impulse waves moving with the trend, while waves 2 and 4 are corrections. But here is where Constance flips the script. She doesn't start at the beginning of the move. She starts in the middle. This is the strongest segment strategy. On your trading platform, identify the steepest and most vertical part of the rally. That is almost always your Wave 3. Wave 3 is the point of recognition where laggards, pros, and weak hands all jump on the same side of the market. Once you find that midline, you can use the Box Duplication method. Draw a box from the low to the end of Wave 1, duplicate it, and stack it on top. This creates a geometric projection for your target without needing complex Fibonacci tools, though those levels often cluster in the same area.
It's like a long-distance runner. Wave 1 is the start, but Wave 3 is the runner's high, where the pace becomes unsustainable. Wave 5 is the final sprint on pure adrenaline. If you see the boxes getting shorter, what we call contracting box heights, the market is weakening and becoming parabolic. This is your signal to start looking at a Gold IRA or a defensive cash position before the trend kills itself.
But what about the rules? I've heard Elliott wave has too many exceptions.
Constance keeps it pragmatic with 2 unbreakable rules for beginners. Rule 1. Wave 3 can never be the shortest of the 3 impulse waves. Rule 2. Wave 4 cannot retrace into the price territory of Wave 1. If you see that overlap, you are not in a standard impulse trend. You are likely in a termination wedge. To survive as a long-term investor, you must realize that corrective waves are the connective tissue between explosive impulse trends. The market breathes through correction. The technical framework begins with a 3-legged structure, A, B, and C. The first major pattern to master is the zigzag. This is a sharp, fast reaction that begins with a clear 5-wave decline. If you see a 5-wave drop in a bull market, do not panic. It is often only one leg of a 3-part structure. The B wave bounces, fails to make a new high, and the C wave breaks the low of A.
But the real asset trap is the flat correction, or what we call the N pattern. Unlike the sharp zigzag, a flat is a choppy sideways mess where each price bar is nearly retraced by the next. The most deceptive variation is the expanded flat. In this structure, Wave B actually breaks above the previous high, tricking retail traders into thinking the trend has resumed, only for Wave C to reverse hard and crash through the original floor. It traps early shorts, then late buyers, then punishes everyone who mistakes a breakout print for real structural acceptance.
Here is where geometry becomes practical. Ask not just whether price fell, but how it fell. Was it sharp and directional? That points toward a zigzag. Was it overlapping and indecisive? That points toward a flat. Constance's ExxonMobil example showed a textbook expanded flat. Wave B traded above the old high but failed to close there, and Wave C flushed weak hands before the larger trend resumed. I applied the same logic to 2026 Bitcoin Ethereum rotations. My verdict? Never buy the first dip in a zigzag. Wait for Wave C capitulation volume and check the oscillator for bullish divergence before rebalancing. If you want to avoid the most brutal asset traps in the market, you must recognize the termination diagonal triangle, also known as the wedge. This pattern carries a devastating message. The trend is exhausted, but it is still trying to look alive. These patterns usually appear in the 5th wave position at the end of a long rally. Instead of separation and force, you get overlapping internals, 3-wave pushes, and progressively flatter slopes. The public still sees price making highs. The trained eye sees exhaustion organizing itself.
If it's a trend killer, why not short it the moment I see a wedge?
Because that is exactly how you get liquidated. Wedges are sneaky. They grind onward, make marginal new highs, and trap early sellers. The safest place to enter is not at the tip of the wedge. It is when the market stalls and then breaks under the lower trend line. A true termination wedge often retraces violently back to the origin where the wedge began. Imagine a car trying to climb a steep hill while running out of gas. It lunges forward, rolls back, lunges again,
but each lunge is shorter and more labored. Eventually it stalls and rolls all the way back to the bottom of the hill. That rollback is your profit opportunity. Look at the 2011 S&P 500 mini futures case study. Retail traders bought breakouts in the middle of Wave 3, while professionals watched the bar lengths getting shorter and shorter. When Wave 5 exhausted itself, the reversal retraced the entire pattern. I've seen the same behavior in 2026 Gold IRA inflows. Wait for bearish divergence on the Composite Index at old resistance before closing longs. While Constance Brown's framework is a masterclass in geometric proportion, we have to talk about the BS that will get you killed in the 2026 economic landscape if you follow it blindly. The biggest risk factor in this methodology is the hindsight bias inherent in leading diagonal triangles. Constance herself admits these patterns cannot be detected in real time as they develop, and are only revealed after the fact when the larger move becomes transparent.
Exactly. If I can't see it until it's over, how is that a strategy? It sounds like a Wall Street way of explaining a loss after it happens.
This is where we have to adapt the model for 2026. Leading wedges are very rare and typically only found in Wave A or first wave positions. In the age of high-frequency trading and AI-driven liquidity sweeps, these rare patterns can be manipulated to look like real reversals. That means the pattern is not useless, but it is lower confidence unless confirmed by additional structure, momentum character, and benchmark bar behavior. When rarity meets machine noise, you demand more evidence, not more confidence. Another major point of failure is the reliance on standard RSI. Constance correctly critiques that RSI often fails to detect trend changes, which is why she developed her Composite Index to identify when momentum is actually failing behind the surface. Think of it like navigating a modern supercar with a 1920s map. The geometry of the road has not changed, but the speed of the vehicle has. If you are waiting for a termination wedge to be perfectly labeled before you hedge your portfolio, you are already late.
So what's the Wall Street reality check? How do we hedge this?
You adapt. We don't wait for the pattern to become transparent. We use modern trading platforms to set alerts for vertical displacement shifts. If the price range of a bar exceeds the previous longest bar in the trend, what Constance calls a new benchmark, you tighten stops, reduce exposure, or buy volatility protection. The goal is not to win a labeling contest. The goal is to survive the break. My testing showed that layering an AI-driven momentum overlay on top of the box method increases the accuracy of identifying these trend killers before they break the lower trend line. The edge is not prediction for prediction's sake. The edge is earlier recognition of unstable structure. When a benchmark bar expands, slope flattens, overlap increases, and momentum refuses to confirm, you stop thinking like a narrator and start thinking like a risk manager.
Here is the consensus. Constance Brown's geometry is still your shield. But in 2026, blind loyalty to the pattern is a liability. Respect the box. Respect benchmark bars. Respect momentum divergence. And above all, respect the speed of modern liquidity. Capital preservation is not fear. It is the discipline that keeps you alive long enough to exploit the next clean trend.
We've covered a lot of ground today, from the geometry of balance to the exhaustion signals of a dying trend. Here is your micro win for today. Go to your trading platform and draw a box around the strongest vertical segment of your top-performing asset. Duplicate it and stack it on top. If your current price is already at the ceiling of that second box and your oscillator is showing a lower peak, you are in a high-risk zone. It's time to rebalance.
I've done the boxes, but some of these charts look like a total mess. How do I know if it's a flat or a zigzag in real time?
That is the million-dollar question. Mastering these impulse assets is just step one. But there is an even deeper level of market deception. Without the advanced playbook for complex corrective patterns, the double zigzags and the triple three connectors, your portfolio is exposed to the most violent liquidations the market has to offer.
So the biggest trap is not the first correction. It's the second deceptive leg after you think the danger is gone.
Exactly. That is where most retail capital gets trapped twice. Next episode, we are diving into the hidden mechanics of complex corrections. We will show you exactly how to trade the X-wave connector, the secret bridge that elite hedge funds use to trap retail investors in a second, even more brutal decline. If you have capital in crypto or real estate, you cannot afford to miss that session.
The consensus is clear. Constance Brown's fundamentals are your shield, but the advanced patterns are your sword. To get a head start, download my raw 30-day performance data and the 2026 wedge detection cheat sheet at EDUxify.com.
Subscribe now and join the 1% who trade with geometry, not guesswork. I'll see you in the next deep dive on the EDUxify brand ecosystem. And next time, we go beyond simple corrections into the hidden mechanics of complex corrective movement, where the X-wave turns one trap into two. Until then, protect your capital, respect the structure, and remember, geometry sees what guesswork misses. EDUxify.com.
Shield first, sword next. See you in the X-Wave session.